as the Federal Reserve continues to raise interest rates and even more banks collapsed in the great financial crisis of 2007, and the politicians in Wall Street rewrite the rules, or should I say, flat out break them, to let Jamie Dimon and Chase consolidate power and control in the economy and what's left of the financial system so they can privatize the profits and socialize the losses. And we, the people, sit and wait and wonder when the financial house of cards will spill over into the real estate market as rents crash in Las Vegas. But of course, it's all for your safety. Which brings us to our May market report, where we look back at all the Las Vegas housing numbers that matter from April that are brought to us by the Las Vegas realtors. So before we get into the video, if you don't know who I am, I'm Ken Blumberg, your all-American realtor. I'm a 17-year Las Vegas real estate agent, and I'm helping you to live the American dream. So before we get into all the Las Vegas housing numbers, I want to bring your attention to an article that I just saw. Americans' views of real estate as the best investment decline, according to a new poll by The Hill. So the article says Americans' views as the best long-term investment are declining as the housing market cools from its pandemic-era peak last summer, according to a new poll. Slightly more than one-third of Americans polled by Gallup chose real estate as the best long-term investment option this year. And although this is par for a typical year, it marks a sharp drop from the record high in 2022, when 45% chose it as the best long-term option, which indicates to me that we have very short-term memories and recency bias and have already forgotten about what happened in 2007. Gallup noted that real estate views were not tethered to home ownership because renters and owners are statistically as likely to say it is the best investment. The housing market has cooled rapidly amid the Federal Reserve's fight with inflation, which led the central banks to increase interest rates 10 times. During that time, mortgage rates more than doubled from the lows of around 3% to a high of 7.8% in November. This pushed monthly housing payments to new highs. Yet the consumer CPI, a key measure of inflation the Labor Department released Wednesday, showed inflation slowed in April to the lowest annual rate since 2021. Shelter costs, which make up 40% of the core inflation, rose by 0.4% in April, the CPI showed. It was also the largest contributor to the monthly increase in overall inflation. The cost for a shelter has increased by 8.1% in the past 12 months on an unadjusted basis. But the inflation slowdown in April could give the Fed room to pause rate hike, which could offer relief to prospective buyers. While views of real estate investments declined, there was a rise in Americans' perception of gold, savings accounts, and bonds as a long-term investment option. Perception of gold as a long-term investment jumped 11% from a year ago to 26%. Which is no surprise, because when you can no longer trust the financial system or the housing market, you have no other choice but to move to other financial assets. Gallup's poll results are based on telephone interviews conducted from April 3rd to April 25th with a random sample of 1,013 adults living in the United States and Washington, D.C. So to jump into the numbers from April, we had 2,451 new homes hit the market, which was down 4.4% from the month prior at a time when we expect inventory to start increasing. That number was also down 33.2% from the year prior, which is very, very surprising in my opinion. And when you look at this next chart, you can see that we've never had this few new listings in April when you look all the way back to 2007. So the next number we're going to look at is effective months of available inventory, where we had 1.9 months of inventory in April. That number is up 7.2 from the month prior, and it is up 134.2% from the year prior, but historically very low, where a typical balanced market is right around 5 to 6% effective months of availability. So even though inventory is rising, it is still amazing to see that the homes that are going on the market are still being absorbed, as demonstrated in this next chart, availability excluding offers, where we had 3,733 homes that didn't have any offers. And again, at a time when inventory is supposed to be rising, so that's down 10.9% from the month prior. So buyers are in the market and they are actively looking for homes. There's just not a lot of inventory available. However, it's still up a substantial amount by 53.1% from last year, where we had 3,570 homes on the market last April. But still, it's an incredibly low number of homes that didn't have any offers. Next, we're going to look at the number of closings for last month, where we had 1,962 single-family homes closed, which is down from the month prior by 16.9% and down from the year prior by 34.6%. And lastly, we're going to look at the median closing price, which I think is probably the most telling statistic in this data set that we're looking at, where we had the median closing price for April that was $430,000. And even though that's up 1.2% from the prior month, in a month that we typically expect prices to go up, it was down 9.5% year over year. Narrative is that there are very few homes on the market, which is true at this time. No one likes to lose $52,000 on their home's value after purchasing just 1 year ago. It kind of makes you lose faith in the system, as I alluded to in the earlier article that we discussed in this video. So lastly, if you're thinking about buying a home right now, I think we need to discuss what's happening in the rental market. Now, typically, I would always say that you're better owning than renting for the long term, but this article makes a very strong case for waiting to purchase a new home in the short term. Let's jump into it. This article is from a very popular YouTuber called Reventure Consulting, and the article's headline is "Landlords Can't Rent Their Apartments, Vacancy Rates Are Surging." So as you can see in the next chart, the number of rental units, both single family and multi-unit, that are backlogged to be completed is massive. It is at the highest number since the 70s. So there's going to be a ton of this rental inventory coming on the market, but we'll get deeper into that in a couple of minutes in this article. But they go on to say, lost in the discussion of the 2023 housing market is what's going on with rentals, in particular vacant rentals. The tides have definitely turned south in the rental market, and we are now seeing a big pileup of vacant units sitting on the market with no rentals. The result is that landlords are being forced to cut rents, especially in certain cities. And you guessed it, Las Vegas is once again in the crosshairs of this new massive shift that's taking place in the housing market. So the article goes on to say declining rental prices equal declining home prices. The first thing to understand about the rental market is its relevance to the housing market and home prices overall. If rental vacancies increase and rents go down, that will eventually translate into lower home prices through two main mechanisms. And in my opinion, this is definitely also going to impact home prices in Las Vegas significantly, because of the very large number of renters in Las Vegas who have not been able to achieve the American dream of home ownership. So when we look at the United States Census Bureau statistics, we see that only 53.7% of Las Vegans are homeowners, which means that 46.3% of people living in Las Vegas are renting. So the article goes on to say that real estate investors won't be willing to pay as much for housing and apartments if their rental cash flow potential is lower, thereby pushing down prices. The next point is declining rents will incentivize more would-be first-time homebuyers to stay as renters, depriving the housing market of buyer demand from a structural standpoint and requiring home prices and mortgage rates to go down further to entice buyers back into the market. So they go on to say Phoenix, Las Vegas, and Jacksonville are three Sunbelt metros which have seen their local rental markets go bad in recent months. And next, the article talks about Phoenix being a very rough rental market, but we don't really care about that, at least at this second. My heart goes out to Phoenix. So let's just keep it to Las Vegas. After we say that according to Apartment List, the apartment vacancy rate in Phoenix is now 7.2%, the highest level in at least 6 years. They go on to say that Las Vegas is another market with similar issues. The rental vacancy rate in Las Vegas has more than tripled from its pandemic low of 2.5% all the way to 8.3% today. Once again, the highest level on record in Apartment List data set. So in this next chart, you can see even though rental prices are coming down, the number of rental vacancies is spiking. So now we see the chart, and the article goes on to say that Las Vegas is dealing with a combination of higher vacancy rates and lower rents. And like Phoenix, rents are also declining in Las Vegas from a high of $1,575 a month down to $1,497, which is a 5% decline. These rents have actually ticked up slightly in recent months for seasonal reasons. However, I expect them to continue their downward trajectory as 2023 advances due to elevated vacancy levels. And the article goes on to talk about Jacksonville, Florida, but we don't care because we are going to strictly keep it about what happens in Vegas on this video. So the article goes on to say that investors own approximately 30 to 50% of all rental homes in these cities, as I mentioned earlier in the video, according to Redfin's data set, who is coincidentally also laying off people at a very rapid rate now that the fake fiat low interest rate gold rush is over. But don't worry, I'm not going anywhere. I've been doing this 17 years. This is what I love. I put my heart and soul into helping buyers and sellers. So I'm pretty confident I'm going to be around to help you if you ever need me. But let's continue. So next you can see in this chart that almost 50% of the homes in some of the zip codes in Phoenix are owned by investors. So the next logical question is, what happens to the housing market in these cities and zip codes if the rental market continues to decline? And of course, my friends, this is because we're in a manipulated economy where investors don't know and can't know what the Federal Reserve is going to do as they're raising interest rates at the fastest pace in 40 years. So it's very likely that investors are going to take a lot of the blame. But this is just a distraction because we all know we're living in a manipulated economy where other people, i.e. the Fed, shake up the etch-a-sketch of our lives and reset the game whenever they feel like it. So they always win, which makes it very difficult for people like you and me. So guys, I'm going to wrap it up there. The article goes on to say it's going to be a pretty messy situation. Most investors are holding on right now, but the article is predicting that there is going to be massive pain ahead because of the statistic that I showed you earlier, where there's going to be more than 1 million new housings coming to market in 2023 and 2024. So guys, if you're looking to buy a home right now, you might want to consider holding off, but this is not financial advice, of course. You make your decision. Again, if you are going to buy, I would say buy for the long term. Be willing and able to hold a downturn in the economy, and don't be surprised if home prices decrease in the next couple of years. But we will keep a close eye on the Las Vegas and national market and see if the housing market unravels in spectacular fashion like we saw in 2007. So guys, thank you for watching. I'm Ken Blumberg, your All-American Realtor. Don't forget to like, subscribe, comment. Let me know if you think I'm right. Am I being too cynical, or am I right on target? You let me know, and I will see you in the next video.